Okay, guys, we'll go ahead and get started. This is our weekly training call for the Dynasty Trust. This is our Dynasty Trust Q&A call and training. For those of you guys that have watched the masterclass, you have some questions, you want to know a little bit more about it. This is what this call is all about. So this is not going to be the 2-hour masterclass that is on our YouTube page and in our website training. Obviously, if you haven't gotten access to that, I will be dropping the link in here in a little bit so you can watch that. But this is just really just an overview, kind of 30,000 foot view. And then you can watch our, masterclass series on our YouTube channel and all that stuff. So we'll just kind of get into this. Obviously, when it comes to tax stuff, everyone's situation is different. Everyone's situation is unique. So there is no, nothing in here should be construed as, tax advice or anything of that nature. Um, I'm not an attorney. I don't play an attorney on TV. So just kind of understand when it comes to, financial, legal, accounting, tax advice, we have the forensic CPAs, tax attorneys, estate planning attorneys. If you want to talk to those people, more than happy to, have those introductions. Obviously, it's going to cost you, 1,000, 1,500 bucks an hour, whatever they charge. But this is really to give you the meat and potatoes of what you need to know, because a lot of this stuff you don't need to, pay an attorney to understand this. You just have to understand how trusts work, how trust law works, especially when it comes to taxes, which is what I specialize in, and all that sort of stuff. So this is really just for educational purposes only. So before we get started, just know that, again, this is a training session. We're going to go over, a good amount of stuff, but towards the end, we're going to have a Q&A and whiteboard session. And I really, really want to make this call about you guys, about what it is that you've, kind of researched or heard about Dynasty Trust. Maybe, again, some questions from the masterclass trainings. So you can really understand, okay, does this make sense for me? Because it doesn't make sense for everyone. So at the end of the day, does this make sense for me? And how is it going to apply in my particular situation? So kind of understand that this is what this call is all about. And again, if you want to learn more about the Dynasty Trust in detail, again, go check out our masterclass videos and stuff like that on our YouTube channel. Questions, type those in the chat. Again, you can unmute yourself during the end of the Q&A session. If you want to unmute yourself before, that's fine. But the more questions you ask while we're going through everything, the longer it's going to take. So, I don't want to be here until, 10 o'clock at night. And just please keep the questions relevant to Dynasty Trust. A lot of times people come in here and say, oh, I got this Wyoming LLC and this Delaware this, and I'm hiring my kids. I'm like, that's great, but let's talk about Dynasty Trust. That's what this call is about. So if you want to, have a one-on-one, consultation about your particular situation in detail, we can set up a one-on-one call. It's 97 bucks. We'll talk about that more towards the end, but this is really to make sure that everyone has a better understanding of kind of how this structure works. And again, whether it makes sense for you or not. So Prudent Wealth Strategies, that's the name of our company. I'm Stefan Bellholm. Michelle Nice is my partner as well. She is not here tonight, so she's usually on the calls with me, but she's not. We are tax trust and estate specialists. We're also trustees, so we manage about 3 trusts, soon to be 4 trusts. We started to deal with a local CPA firm close by. So we provide consulting, education, implementation, and management of specialized tax structures and instruments. So when it comes to a lot of the stuff that I'm going to talk about tonight, these are things that not only we can educate you on, but we can consult and we can put these things together. Again, we have the team and we can manage and oversee and do the compliance. That's kind of my background. I'm a former enrolled agent with the IRS, soon to be an enrolled agent again. I have to retake my test because there's just such a demand with understanding how to implement these things. And our clients are, high-income business owners, investors, entrepreneurs, and highly compensated W-2 employees. So if you're a W-2 employee, we'll talk about this structure in particular. Maybe this structure may not be the best for you because it's not going to really help. And you'll see that when it comes to reducing taxes on W-2 income. But there are other strategies and we can, kind of have those conversations. So our team, again, fiduciaries, we have forensic CPAs, tax attorneys, estate planning attorneys, enrolled agents, specialists of all kinds. A lot of them were former SEC, they work with the SEC or work with the IRS. They teach at colleges, they've written books. So these are really experienced people that know what they're doing when it comes to a lot of these things. And that's why this is so important because a lot of times when you're on, social media, YouTube, Instagram, TikTok, everyone's saying everything. And a lot of these people, they don't know what the heck they're talking about. They know little bites here and there, but they don't understand kind of the bigger picture and how these things actually work. And that's really what, we're here to do. So, just an example of some of the tax structures and instruments that we use: special purpose vehicles, private foundations, donor advised funds, trust, private placement. Again, we're going to be talking more specifically about dynasty trust. There's lots of trusts out there. A lot of people get confused, the different types of trusts. And this is a particular unique type of dynasty trust. And even within the realm of dynasty trust, this is something that's very unique and niche because not all dynasty trusts are the same. Now, when you work with us, this is not about taking away and breaking down everything that you have. If you have a CPA, a money manager, financial advisor that you're working with, great, keep those people. We just want to be plugged in and become part of your team to help you be more tax efficient. A lot of times we meet with people that are really successful in what they do, but they're just paying a huge amount of taxes and they're doing the best they can. Hey, we buy a truck. I was talking to a guy the other day. We buy a skid steer. I'm in North Carolina. So, we buy a skid steer every year because that's the only thing that we can do. And guy's got like a whole bunch of acres with skid steers that he doesn't really use. He just bought it for the tax deduction. So there are more efficient ways to do things than just buying equipment or putting money in a retirement plan. And it's just about understanding how to use the tax code. And when we talk about dynasty trusts in particular, it's about learning how to expense things versus taking taxable distributions. Now, our process is pretty simple. We provide the education and the consulting. We break it down: education, evaluation, execution. Everyone is at a different place in what they're looking to do. And again, we'll go through a lot of this today. Where are you at? A lot of people, hey, I'm, not really sure. I just started a business. I'm just kind of getting my feet wet. Want to understand how structure works. Should I be an LLC? Should I be an S Corp? Should I do this? Should I do that? And so they're in the education phase. And again, we provide a lot of that through the Tax and State Academy. But a lot of you are kind of past that. Hey, I've been in business for a while. I know kind of what I'm doing, but I just need help getting these things done. And so that is where, the evaluation, the execution part, helping you understand, hey, a little bit more how these things are going to work and how to actually execute it, pull the trigger, and see the actual end result. It's a bad screenshot of me. Amanda took it, but this is our YouTube channel, the Tax and State Academy. If you haven't already joined that or subscribed that, I encourage you to do that. Again, a lot of our master classes, other trainings are on there. We provide that so people can really get educated. That's really our goal, is to educate people on the true stuff, the real insider stuff of how these things work, not just I read this on, Reddit or YouTube or, looked like a good idea. No, this is how these things actually work. So check that out. Our approach when it comes to taxes, it's really, I was talking with a business owner the other day about, we did an evaluation. It came out that he overpaid about $375,000 in taxes. And he had a really good CPA. The CPA worked at PricewaterhouseCooper. Really, guy knows his stuff, but there was a few things missing. So we look at taxes holistically. And what I mean by that is we look at recovery, reduction, and restructuring. So we're going to look at, hey, your current situation. What are some opportunities? Maybe you overpaid taxes last year or the year before. We can go up to 3 or sometimes 4 years back to see what opportunities are to get you money back that you overpaid the IRS. A lot of people don't really understand and know what that means. Maybe they, got some PPP loans and, ERTC and all that stuff, but there are so many things over and above that a lot of business owners and investors are completely unaware of. And the crazy thing is that there is a statute of limitations. The IRS isn't here to inform you about these opportunities. And once that statute passes, once the 3 year mark passes, boop, you can't go back and get it. And that's money that's gone. So, and that you're rightfully entitled to. So that's kind of our first thrust approach when it comes to the whole holistic tax planning approach. But then reduction. What can we do to proactively reduce your tax liability? 2025 is almost over, 2026 is starting, and we're having conversations with a lot of our clients right now about, hey, we're going to sell a business.
Mic on? No.
Hey, I'm going to mute you, Mike. Just make sure you mute yourself for right now. Um, hey, we're going to be, scaling our business for 2026, and we're looking at strategies and structures right now so that, hey, you're going to, 2, 3x your gross income. We can still reduce your tax liability, but it's about looking at things now versus at the end of the year where it's just, hey, buy a truck, buy some equipment, or put money in a retirement account. And then finally, it's restructuring. It's looking about taxes in the future and figuring out how we can change where you're at right now so that you're not heavily taxed. And a lot of CPAs, their first go-to is, hey, put money in a 401k or an IRA or a pension. And that's fine. That'll help you with your tax liability now. But when it comes time for you to take that money out, you're going to get killed in taxes. And we deal with a lot of people that are in their 60s, late 60s, early 70s, and they're starting to realize, holy crap, I have a whole bunch of money I'm taking out and I'm getting killed in taxes. And so the structuring part is looking at ways to recharacterize where your money is so that you're not paying a whole lot of taxes or you're paying no taxes at all. And there are so many ways, Roths, private placement, life insurance, trust, we'll talk about that. And we say this a lot, where your money is just as important as what it earns. You could be getting a 10, 12, 13, whatever rate of return you think you're getting, but if you're paying taxes on that, how much are you actually getting? And when you're a lot older and you're in retirement, you end up paying a lot more taxes than you think. So the agenda, again, we're going to be going over what dynasty trusts are, what they are not. So there's a lot of misconceptions about dynasty trusts, why people use them, who they're for, and who they're not for. Again, as I explained before, this strategy is not for everyone, and really how the dynasty trust structure works and how it's used. Because this is a strategy that, if you really understand it, this is going to completely change the course of how you do things. It changed course of how I do things personally with my family because this is a strategy that I utilize. So when I talk about this is not just, hey, he's just some talking head. I actually do this myself. So that being said, so again, dynasty trusts are not for everyone. Okay, we'll go into the specifics, but I really, a lot of people like to say, oh, sounds good. No, it isn't good for everyone. Different strokes for different folks. So it's not a strategy that's going to work for everyone. But what we want to start off is the primary reason why people set up trust is simply to avoid probate. And literally, that is the basis of trust, right? Transferring assets from one generation to the next without having to go through the probate process. And for those of you guys that don't know what probate is, probate is a court process where basically the government is getting involved, right? The judicial system, and their whole goal is to figure out how to distribute your assets when you die. Okay, and so essentially the courts are going to decide who receives your assets. If you don't have any documentation, if you don't have a trust, or even if you have a will, a lot of people don't realize that if you have a will, if that's the only thing you have is a will, guess what? That will is going straight to the probate courts. And anytime you're dealing with courts, you're dealing with lawyers, judges, money, time, and stress. And it's a lot of the things that most families don't want to have to deal with if they can. And so that's the whole reason that trust exists because, hey, if we transfer our assets in the trust, and it's structured and managed the right way, and that's a huge thing because a lot of people will spend five, six, seven, eight, nine, $10,000 on a trust, and then still go through probate because they don't understand that whoever the grantor who set up the trust didn't do what they needed to do to actually avoid the probate process. So that is like number one reason why 99% of the population out there uses trust is to avoid probate. But wealthy people use trust to not just avoid probate, but avoid taxes, avoid liabilities, avoid lawsuits,
Would
and
you like me
avoid.
to use GPT to?
No, I would not like you. Siri's always listening to me. Anyways, and avoid publicity, avoid having all of their stuff out in the open. So the key thing here to understand when we're talking about the dynasty trust concept is that this is a trust that you're going to use right now while you're alive, right? You don't have to die to benefit from the trust. As a matter of fact, when you die, you don't really benefit from the trust. Your heirs do, which essentially, yeah, it's an extension of you, but they're really the ones who get the benefit, not you. And so the dynasty trust allows you to kind of have your cake and eat it too at the same time. And this is not a new concept. Right, we hear about all the wealthy families that use trust, right? The Walton family, Walton Family's Holdings Trust. This is what they use to keep control of their company. They use their trust now while they're alive. AT&T, they use the reverse Morris trust strategy to avoid $43 billion dollars in taxes, capital gain taxes. Actually, not $43 billion dollars. It was a $43 billion transaction, which you can imagine what the tax bill is, but no taxes on the gain from that deal because they use the trust. Dynasty Trust, which we're going to talk about today. The Kennedys. If you know anything about the Kennedy family and Joe Kennedy, the bootleggers, right? This is how he became wealthy and kept his wealth, and why the Kennedy family till this day. I was reading something the other day. It's about 170, heirs are that benefit from the Kennedy Trust. It's Dynasty Trust. This is how the Kennedy family fortune was built and is growing and is only going to get better, is because they understand how to use trust. As you can see it there at the bottom, the Dynasty Trust maintains if handled correctly, right? We'll talk about structure and all that stuff, can maintain an untaxable fortune indefinitely. Indefinitely. That means pretty much forever, right? So Romney, Mitt Romney, that was a big thing when with his election a few years ago, is using trust, his family trust. So this is not foreign. A lot of you guys might have heard of these things before, but I'm here to tell you, even though there's all these wealthy families, the Rockefellers, the Gettys, the Bushes, we can go on and on and on. You don't have to be a gazillionaire or a billionaire to benefit from a trust, to utilize these trusts. That's the biggest message that I try to explain to business owners and investors, and even a lot of high net worth families. I was talking to a guy the other day, they're worth about maybe $38 million dollars, and they knew nothing about Dynasty Trust, and they're getting killed with taxes. Plus, they have an estate tax issue. And it's because the mindset, the belief is, hey, these are for these mega, mega, mega billionaires. And it's not. It's when you understand how to use this stuff and how tax code works and how trusts work, and how income works. We'll talk about that because this is really it's a tax play. It just makes your situation whole much better. Forbes put out this article a few years. Trust funds are not just for the wealthy. So it's this message is slowly starting to become more prevalent. And I can tell you, the 20 years, almost 20 years that I've been in financial services, I didn't learn about trust like this. And learning my classes in college with accounting and stuff like that. My dad's an accountant. They don't teach you this type of stuff when it comes to trust. It's just, hey, there's these are for the ultra wealthy people. You're never going to have to deal with it because you don't have clients like that, and you never will. So it's just a fallacy. Um, Lots of different types of trusts. Again, we talked about that: land trust, revocable trust, charitable needs, charitable remainder trust, special needs. Right. This is one of the biggest reasons why people get confused with these trusts, is because they hear this and that and this and that from every different corner and angle, and they don't know how to decipher trust and how trusts work. This is obviously not an exclusive list. There's over, hundreds of trusts out there, but this is one of the biggest reasons. And I try to make things simple and easy and break it down, because when you boil it down, all trusts are essentially the same. It just boils down to the provisions, right? And what you want that trust to do. And one of the biggest things that I explain to people is your trust is directly, the benefits that you get from your trust is directly proportional to how it's set up and how it's managed. So we'll talk about the governing instrument and the provisions and all those things. But if it's not set up, and even if you have it set up, but you're not managing it right, you have a dynasty trust, you're not doing your bookkeeping, you're not doing this, you're not staying compliant, you're not going to get all the protections and benefits that you need. So dynasty trust, that's what we're here to talk about. Who is this for? Basically, again, it's not for everyone. It's really for people that are business owners or property owners. So if you have real estate, It doesn't matter if you have 5 properties, you have 50 properties. This is a strategy that you might want to consider, and we'll go into detail why. Investors, doesn't matter what kind of investments you have, real estate, stocks, crypto. It's just a no-brainer, and you'll see why when it comes to passive income and kind of how things work with this trust. Um, I think we have someone that's not. Could you please mute yourself? I don't know who it is. Thank you. Appreciate it. Syndicators, we have a lot of people that have limited partnerships and stuff like that. This is a great strategy. And if you're self-employed, so we'll talk about W-2, 1099. If you're 1099, you're a salesperson, you're in commissions. We're working with an insurance agent here locally in Raleigh-Durham. So I'm in the Raleigh-Durham area just for reference sake, but we have clients all over the country. But yeah, we're showing them, we're setting up their trust structure right now. So even if you have an active, business, this is something that you can employ. Who is it not for? Well, basically, if your only source of income is W-2, and these are broad strokes, so generally speaking, if your only source of income is W-2 or 401k, Social Security or pension income, what we call declared income, where you have to pay taxes on it, this strategy is not going to help you from a tax perspective. Okay. Once you earn your money, you pay your taxes, and you want to find a good, efficient way to shelter those assets, okay, then we can consider, setting something like this up, but it's not going to help you mitigate taxes on any of those incomes that you see here in red. So again, if you don't have business, investment, real estate income, anything like that, it's not really beneficial for you to set it up from a tax perspective. We'll go into maintenance and all that stuff because there is a cost to, not only set up the trust, but to maintain the trust. You're going to have to do a tax return every year. You're going to have to do books. You're going to have to, do a balance sheet, all these different things. So there's all these things that you need to kind of understand. Hey, a lot of what I talk about may sound good. Oh, this looks good, but there's things that you have to consider as well in the back end. So when it makes sense for the most part is when you have over $1 million in assets. And when we say that, we specifically mean liquid assets, non-retirement assets. So real estate investments, brokerage account, whatever, that's not in a IRA or 401k. An IRA, and the reason is an IRA or 401k is a trust. So we deal with a lot of people. We have conversation with them and they have a self-directed account. Okay, that's great. You don't necessarily need that for the trust. That is a trust in and of itself. So if you have investments and assets in those types of accounts, that is not going to necessarily qualify when it comes to the a million plus, threshold or whatnot. So anything that's outside of that in an LLC, in a corporation, in your personal name, and we'll get into that. That's what we're talking about. Or from an income standpoint, hey, we have an active, business, or we do rental income. We have rental income, or we flip properties, or we trade crypto, whatever it is, Forex, any type of income like that. Again, not W-2, because it's contractual, and we'll talk about contracts. You go to your employer, say, hey, I'm doing this job and you're going to pay me $300,000 a year. Great, that's contractual. You have to pay taxes on that income. That's not anything that we can redirect into the trust. So just kind of understand that from an income standpoint, it has to be non-W-2. But once you earn that W-2 income and you pay taxes on it, what you do with that money, again, where your money is just as important as what it earns. If you wanted to put that in the trust, that's definitely something that you can do. And we'll talk about how that works from a sequence standpoint. So Dynasty Trust benefits, it's, the big benefit with this is, again, it's a tax play. It's going to give you tax control. And most people, they don't have tax control. You either have an LLC or an S Corp, you don't have tax control because it's all going to you. And you can't do anything about that. Put money in a 401k, it's going to you at some point in the future, right? So this strategy gives you tax control, gives you asset control, privacy control. Hey, we don't like all of our stuff out there in the open for people to see. Liability control, and then probate control. We'll talk about kind of how that works from a legacy standpoint. And again, as I explained before, how your trust is structured and managed is going to determine the amount of benefits that you have. So all these benefits are great, but even if you have a revocable living trust, again, you don't fund it the right way. You just say, hey, I assign my property on 123 Main Street, put it in the Schedule A in the governing instrument. That's not going to fly. If you didn't actually fund that property, go down to the courthouse and transfer the deed over into the trust and name everything the right way, you're going to go through probate. And if you have a dynasty trust, you set up a dynasty trust, but you're not operating it the right way. You're not, paying your trust, rent if you're living in the house in the trust. We'll get into that. You're doing all these things. You're not going to have the asset protection that this kind of trust gives you. So everything boils down to structure and management when it comes to trust. So the premise of the dynasty trust is at the end of the day, while you're alive, there's two estates that you can operate out of. You can operate out of your personal estate, right? Have your name on things where you own things, but you have to deal with taxes, liabilities, and lawsuits, right? Or you can do things in a trust estate where you don't own it, right? It's not in your name per se, it's in the name of the trust, but you have access, benefits, and control. Fortunately, 99% of the population, this is how they do things. And this is how I did things. So when I talk about this, this is coming from a place of experience. I've been sued. I've go through the whole rigmarole of how things work. And it took all of that for me to realize, wow, this is how this country works. This is how the laws work. And man, I wish I would have known this years ago. But the old saying, no use crying over spilt milk. So 99% of the population, this is how they do things. Their properties, their cars, their bank accounts, it's in my name. And I think a lot of it is societal too, because we're taught, from a young age, work hard, you know, get the degrees, get the experience, take the credit, bought your house, right? You have ownership, own things, right? And I get that. But when you really look at everything, we'll go into this in detail. Ownership is not your friend. And so this is how most people in this country do it. Even LLCs. If you have an LLC, and we'll go into that. LLC, you own it. You put your property in an LLC, oh, it's protected. No. Corporation, same thing. Living trust. Have a living trust. No, you don't have, it's still in your personal estate. That's how the system sees those assets. And most people, even smart people, even people with a lot of money, don't understand that. And so they have to deal with taxes, they have to deal with liabilities, they have to deal with lawsuits, and they're completely exposed. They're completely exposed. We just had a very horrible incident in our neighborhood. Take a sip of water. A kid, it's freaking sad. About a week and a half ago, 2 weeks, at night, kid was drunk. They were like 16, and they were at each other's house, whatever. And this is like 1 o'clock in the morning, and kid goes and kills the other kid while he's riding his bike. And it's just the most heart like wrenching thing ever to me, because now this kid's not going to live to see the rest of his life, his parents, like all of these different things. And then immediately, because of what I do, I'm thinking about the parents, because the parents are now on the hook for what this kid did. This kid who did something stupid, didn't realize probably it was going to change the rest of his life. Guess what? All of the hard work that the parents put together and the houses and the businesses, and I'm not going to go into the detail, and this is, public information. I'm not trying to dox anybody, but they are in deep doo-doo, because it's just, you don't know what you don't know, and no one expects these things to happen, but they do. So you have to think to yourself, what do I have right now? My business, my intellectual property, my assets. What's in my personal name? This is a AI image guy here, but doesn't matter if your name's Alexander Chen or James Jones, whatever your name is. What do you have that's in your name? Because if it's in your name, people can see it and people can find what you have, and you're exposed. And if something happens, it just happens like this. This is I don't care where you are in America, you see these signs everywhere, right? You see Morgan and Morgan, Dewey, Cheatham and Howe, whatever, right? And these billboards, you have to think, these billboards aren't cheap. They cost like 5, 10 grand a month, easy. These are sharks in the water. This is stuff that happens every single day, day in and day out. Accidents on the highway, trucks, this. Again, no one thought, right? A kid would kill another kid. Parents are on the hook. All of these different things happen. We were driving to the beach, a few weeks ago here in North Carolina, and on the way to the beach, you see this, all these people, they have beach houses. They're at risk. It's in their personal names. I can go on the county websites and I can see it. Even in my neighborhood, I can see it. So the reality is, if things are in your personal name, they can get attached. And when you see all of these awards, and this is the big thing that I try to tell people when it comes to understanding asset protection, what asset protection is your LLCs, your living trust, your Wyoming this, your South Dakota that, your Delaware this, Delaware that. Number one, it's only your personal estate. Number two, if you had insurance, say you had an umbrella policy, the reason why you see these 3.5, 4.8, whatever $1 million awards is because when you do something stupid, you run a red light and you hit someone, even if it was an accident, let's say they don't die, like in this person's case, they don't die, they're injured critically or something severe. They're not suing you for your insurance limits. They're suing you for what's called human life value. Okay? It's you hurt that person, you took away their ability to work and earn money, you devastated their family for many years or their lifetime. They can come after you for that, and you're fully exposed. And so it's just something to kind of understand in the grand scheme of things is like, wow, this is where this stuff comes from. I need to do whatever I can to protect my assets, right? Asset protection is for people that have assets. If you don't have assets, don't worry about that. Don't worry about any of this stuff, right? This isn't for you. But if you have substantial amount of assets, you need to be doing everything humanly possible to shield yourself and get things out of your personal name. You put it in an LLC, you put it in a S corp, you put it in a living trust. The lawyers are going to find it. It's 2025. My 10-year-old kid can find your assets through ChatGPT. So when you get sued and the lawyers are looking through everything and they're doing, their discovery, right? As they call it, discovery and their depositions, you got to have your stuff together and they will find everything. But forget about lawsuits, right? What happens if you get severely injured or you get really sick, feeble, Alzheimer's disease, you have a heart attack, a stroke, you need long-term care. You need to be in a nursing home. You need to have, 24-hour care. Guess what? The state is going to make you spend down all of the assets that you have, all those assets in your bank accounts, in your brokerage accounts, in your, even retirement accounts, Roth IRAs. Most people love Roth IRAs, but when I show them and tell them the law in their state that says any money in a Roth IRA has to get spent down, they can't believe it. So having things in your personal name, this is how this country works. FAFSA, we have a lot of clients this time of year. We're helping them with the college stuff, FAFSA, CSS profile. When you're sending your kid to college, how the colleges figure out how much financial aid and grants and money they're going to give you is by looking at your financials. They make you fill out they want your tax returns, they want your bank accounts, they want everything that's in your personal estate, everything that's in your personal name. So things that are in your personal name, you're just prey, and you have to be proactive because we get a lot of calls. One of the big, I'd say 2 or 3 times a week I get a call. Hey Stefan, my brother just got sued or this or that or that. Can you help me? And the reality is no, I can't. I can't because these you've already been served. You've already been, like these things have happened. It's already, docked with the courts. Like you can't do anything now, like you're screwed. Like that's how it works. Otherwise, you're what they call fraudulently conveying things. So when the things happen, you have to have everything done before this. Once it happens, you're SOL. And if you try to do this or do that or maneuver, they're gonna find out, and you don't want them to find out. So at the end of the day, ownership is not your friend. Hopefully, I've proven that to you. But this is why wealthy people do things this way. And I've learned this just through my life experiences looking at things. One of my first girlfriends in high school, her parents were, well, her grandparents were very wealthy. I remember he, they were having a conversation. They're like, "Yeah, we're poor on paper," and I didn't understand that term until years later, and because that's what wealthy people do is they look poor on paper legally. So the reality is, if you don't own it, no one can take it from you, right? If you own it, they can take it from you. But if you don't own it, no one can take away something that you don't own, right? And so putting things in the trust estate gives you actually safety. Not having ownership actually gives you more control, gives you access benefits and control, where most people they think you need to have your name on it to have control. It's the exact opposite. That is the premise of the Dynasty Trust. So again, 99% of the people put things in their personal name. The wealthy, the 1% of the population, uh, don't. They have very, very little in their personal estate. And they do that to have tax control, to avoid liabilities and lawsuits, and to keep things private. Because if you have a lot of money, you probably don't want everyone and their grandma knowing what you have. So it's a whole concept of own nothing, control everything. We contribute this to, John D. Rockefeller, obviously. If you know anything about Rockefeller, you know that he is was one of the most wealthiest people, but he still is, even with today's dollars. I was reading something a few years ago that if you calculated the dollars today, the Rockefeller wealth is still, more wealthier than Bill Gates. But regardless, Rockefeller used trust. Okay, Standard Oil Trust is what Rockefeller used to really skyrocket his wealth. The whole antitrust uh, 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 phenomena that happened in the early, 1900s, that was because of people like John Rockefeller that used trust to corner the market, whether it was in oil or in steel or whatever. All of these barons, this is what they did. They used trust, they used the law. And the funny thing about the whole antitrust thing is that it didn't work. It didn't work at all because John Rockefeller just said, okay, you want to, bust my trust. I'm going to set up all these other trusts. And that's what he used. ExxonMobil, all of these gas, every time you go to the gas station, it's part of Rockefeller. It's their family legacy. It's how they're still growing their wealth now. So these are things that you can utilize as well. Asset protection. So let's go deep into asset protection, talk about things and relate that to the Dynasty Trust. So with trust, basically, and I hate saying this because it's really not true, but you really only have two types of trust, revocable and irrevocable. Within the realm of irrevocable and revocable, that's where you get all these hundreds of different trusts, right? Special needs trust, child remainder trust, all that. So all of these different trusts. But essentially, your trust can either be revocable or irrevocable. What does that mean? Revocable, and this is your living trust, your land trust, is basically all that means is that you can take the property or the asset in and out of your personal name, out of your personal estate while you're alive. Every trust eventually becomes irrevocable. So when you pass away, your trust, if you have a revocable living trust, you put $10 million in there with property and assets and all that stuff, and then you pass away, now that trust becomes irrevocable because you can't put it back into your personal estate because you're dead. So irrevocable just means it's out of your personal name forever, right? You can't put it back into your personal estate unless you literally buy it back. So it's an irrevocable act that you're doing. 99% of the time you call an attorney or you say, hey, I want to set up a trust, they're going to give you a revocable trust. And that's the problem with, how trusts are structured and what people think about asset protection and what that means. Now, how every trust works is you're going to have four different parties. Okay, so I'm just giving you a big 30,000 foot view of how every trust works. Again, all trusts have this in common. The variances is who are these parties and the provisions and a whole bunch of other stuff. But the grantor is who creates and funds the trust. That's who's setting up the trust. The trustee is who controls and manages the trust. The successor trustee is who controls and manages the trust when the trustee dies or is incapacitated. And then the beneficiaries, at the end of the day, those are the people that benefit from the trust. So they get all the money, all the assets, everything from the trust. And again, that avoids probate. So that's a 30,000 foot view of how every trust typically works. But with the again, going back to what I was talking about before initially, your trust, your revocable trust is in your personal estate. So even though you might have titled those assets, those properties in the name of the trust, it is still part of your personal estate while you're alive. So if you have a revocable trust or you have a land trust, guess what? They can still pierce through those trusts and get the assets in them because they're in your personal name. You're the grantor. And so again, this is the problem with most trusts. Number one, when you go to an attorney, whatever, they say we're going to set up a trust, they make you the grantor. Grantor just means owner. So again, if you own something, they can take it from you. So if you're the grantor of a trust, you have no asset protection. Second thing is if it's revocable, those assets can be revoked back to your personal estate. So now those assets can be subject to lawsuits, liens, levies, divorce, turnover, charging order, all these different things, right? When it comes to you getting sued. And the last thing is that from a tax standpoint, is they use what's called the simple tax code. And a lot of times when I tell people this, they're like, "What do you mean simple tax code?" The tax code is in no way simple at all, but this is a literal term, and I'll at the end I'll show you I'll share your 1041 return, but this is the tax code that for trust and estates that requires a distribution. So typically how most trusts work, grandma or grandpa sets up a trust, makes dad the trustee, but the money might be for the grandkids. Once the grantor pass away, the assets get distributed to the beneficiaries, right? And then there's no more trust, right? So that's a distribution of income and assets. When that happens, then there's taxes, right? Because now that income, they have to personally claim that income, right? So there's taxes, lawsuits, and liabilities. So that's a problem with most trusts. Even LLCs and corporations. I let people know this all the time. Great, you set up an LLC, you paid an attorney, five, six, seven, eight, nine, $10,000 to do all these little monkey tricks, but everything that they did, and we just had a case like this with a doctor here in the Raleigh area, went to some guy out in Vegas and did the whole shebang, and now he didn't realize how much he was screwed. Really, I mean, it was something versus nothing. So before he was like completely screwed. Now at least he had something, but he didn't realize, hey, all these LLCs, you are the single member LLCs. Single member LLCs are disregarded entities. It's you. Okay. So LLCs are owned by members, corporations, S Corp, C Corp, they're owned by shareholders. If those shares are in your personal name, if those membership certificates are in your personal name, it's part of your personal estate. And at the end of the day, all of the income from that goes to you. So from a tax standpoint, if okay, great, I made $1 million, I wrote some stuff off, but now, I got the money coming to me, it's going into your personal estate. You have to pay taxes. So that's kind of how that works. And then obviously piercing the corporate veil, I don't have too much time to get into that, but the reality is if you have an LLC or an S corporation and you're not operating it, again, setting it up, managing it, operating it the right way, that can be pierced. And I know attorneys that pierce LLCs and corporations for fun. I have lunch with these guys. This is all they do. And it's super easy for them to do because most small business owners are lazy. You guys are lazy, no offense, myself included. I used to be lazy. Now I'm not because I understand how this works. But you commingle your assets. You don't have monthly meetings. You don't sign things the right way on your checks. It's so easy for attorneys to pierce through those entities. So I don't know who it is. Could you please mute yourself? Or I'll just have to mute you. All right. So the whole thing is again, own nothing, control everything, right? We want to own as little as possible, but have as much control. And that is what the irrevocable trust allows you to do. So while you're alive, if you want asset protection, you don't want to own things, it might make sense to set up an irrevocable trust from the jump, which you can do. But again, most of the time you go to an attorney, you say, hey, I want this. You're going to say, oh, set up this land trust, set up this revocable trust, do this, do that. It's still in your personal name. So there's definitely a mindset thing that has to kind of be understood with, hey, again, this is not for everyone. If you want to set up a dynasty trust, you want to have asset protection, you have to understand, hey, once I sell my assets, once I divulge my assets over to the trust, I don't own it anymore. I can't put my name on it, right? But I do get the asset protection. I do get to control, right? I'm not just giving it away to someone I don't know, and I do get the peace of mind. So if you're willing to part with that, if you're the type of person that has to have your name on everything, this ain't the strategy for you. Okay, I'm just gonna tell you straight up. You get off the call. I don't want to waste your time, but this is definitely not the strategy for you if you like to have things in your personal name. If you don't really care, if you understand how everything works in the legal system and the tax system, and you're like, hey, I don't want to own things, then great. It's a philosophy, it's a mindset, but it's really something that you have to understand. History of entities. We go over this all the time when I talk to people about LLCs and S corps, and just know that I'm not throwing shade on LLCs and S corps. Okay, I use LLCs and S corps. I just use them a lot differently now that I know what I know. But the reality is, if you have an LLC or an S corp, we can make things work with the Dynasty Trust so we can add it, right? It can be an addition to what you're already doing. It's going to make you a lot more efficient. But you have to, if you turn back the clock, you'll see that trusts are not only super old, but S corps only started in the late 19, almost 1960s. That's not that long ago. I don't know how old, some of you guys are on the call, but 1958 is when the S corp election was brought into the tax code. 1977, that was when the first LLC structure was started. I think it was in Wyoming. So prior to that, the people just say, oh no, there's no LLCs or S corps. We're just going to wait to do business. No, they did business in either their personal names, in corporations, or they used trust. Again, the Standard Oil Trust. We'll get into some other things, but this is not something new. Trusts are one of the oldest ways to not only retitle property. You have to understand, trusts are an import from England. They come from Europe. That whole feudal system and all that stuff. I won't get into the history of it. We got a lot of stuff on our YouTube channel and stuff that I'm super excited to put together about the history of trust because I nerd out on this stuff. But this is not only one of the oldest ways to title property, but also redirect income as well. If you look on a W-9, most of you here, if you're investors or you're self-employed or whatever, you probably filled out one of these forms before. What you probably didn't notice is that right here on line 3A is trust and estate. Why? Because that is the way that some people choose to take income from their investments or whatever they're doing, right? So a trust and estate is an actual entity. Not only can you use it for holding assets and transferring assets, but also for tax purposes, business and investment purposes. And most people don't even know that it exists. Again, if you have a 401k or IRA or a pension, those are trusts. They have trust documents. Okay. That is kind of the what we call the governing instrument of how those things work. It's a little bit different, but at the end of the day, it's for benefit of, there's a beneficiary. It's going to be you. If you pass away, you have, alternate beneficiaries. But those are trusts. If you know anything about golf, I love golf. I'm a big golfer. Not the best at golfing, but I love golf. And there's a lot of golf courses. The most famous one is the St. Andrews Links Trust. This is where the British Open is played, but it is managed and owned by a trust and has been so for decades. Hershey's Trust Company, like Hershey's chocolate, right? A Reese's Piece, all the different things they make. Hershey's has a trust. So this is not something new. This has been around for a very, very long time. It's just a lot of people don't know how to use this, or they think, hey, it's far off. It's for the billionaires, gazillionaires. No, it's not. And I'm going to break that down. So tax control. Tax control is super important, right, as a business owner or investor, because it's not about what you make, it's about what you keep, right? At the end of the day, I can make $1 million, but if I only get to keep half a million because I paid the rest in taxes, that's not so good. So, as business owners, investors, all these different taxes that you have to pay, not only federal income taxes, if you live in a state like I do, the state income taxes, California has up to 13.3% tax. That's another tax that you have to deal with. Capital gains, you're buying and selling, after a year, that's a tax as well. There's a net investment income tax or Obamacare tax that you have to pay depending on how much investment income you have. If you've depreciated real estate, this is a huge thing that we talk about to people that are in real estate because they love buying these properties and doing bonus appreciation and cost segregation and all these different depreciation things. It's great when you're buying the property, but when you're selling it and you got to look at that recapture, we got a guy now they're looking at the, thank God they found us, but they were about to pay. We had to not they didn't cancel the sale, but we basically had to delay the closing because they were looking at about almost $400,000 just in depreciation recapture tax, not including the capital gain or anything else. Mortgage over basis, debt over basis, or boot tax. A lot of people are doing 1031 exchange. They got debt on the property. That's an extra tax that you got to pay. And most people don't realize that until they're actually selling and they're at the closing table or they're doing projections before they close and they're like, I thought I wanted to sell, but now I don't because I got to pay all these taxes, right? So taxes are a big issue, and having tax control is super, super important when you're a business owner investor. Billings Learned Hand, he's a former federal court of appeals judge, and he said a lot of really amazing things. You can just Google or chat GPT, Billings Learned Hand. But one of the things, one of the most famous quotes that I like that he said, which I think is the most truest thing ever, is that in America there are two tax systems. Okay, there's one for the informed and people that know, or they pay people to know, and there's people that are uninformed, and both are legal. So understanding how this stuff works, this is not some like gray area, and we'll go through kind of how this works in a bit. This is just about understanding how these things work. Because when you understand, it's like, oh my gosh, now I get it. I wish I would have done this 10 years ago. So it's about using the tax code to your advantage and understand the difference between tax avoidance and tax evasion. Obviously, we're not here to show you guys, and this is what I tell people all the time, teaching tax evasion. So not only is tax evasion and concealing assets, not reporting income. Ooh, meet a lot of people in business, and I'm not here to throw anyone under the bus, but I think a lot of people, oh, it's cash. It's cash. Pay us cash. We don't do. I'm sorry, if it's cash, you have to declare that as income. Okay, cash is taxable income. But so a lot of you are probably doing some tax evasion stuff now. But the reality is not only is tax evasion illegal, teaching tax evasion is even more illegal. It's a bigger federal crime. So we're not here to teach you anything illegal. We're here to show you how to use the tax code to your advantage. And that is the difference between evasion and avoidance. You can avoid taxes legally by using the tax code. The tax code says it itself. Tax avoidance is not a criminal offense. Any attempt to reduce, avoid, minimize, or alleviate taxes by legitimate means, legal means, is permissible. In the tax publications right there, it says it right here. You can Google it. Tax evasion is legal. Tax avoidance is perfectly legal. So I think I said that wrong. Tax evasion is illegal. Tax avoidance is perfectly legal. So it's right there in black and white. So let's talk about structure, how it works. We'll get into kind of how things work. We're almost at the tail end of this, and we'll go into your guys specific situations and go into some Q&A. But the structure of the trust is very, very important. I could literally have a 3 or 4 hour session just on structure and all the nuances with structure. But these are like the main points. Number one, it's not a self-settled trust. So you are not the beneficiary. There are a lot of people that set up what are called DAPT trust or asset protection trust, domestic asset protection trust. These trusts can provide some levels of asset protection, but they don't fly because they're statutory trust, and one state may honor asset protection trust, another state may not honor. So it depends on the area that you're in, but even then, it's not going to help you on the tax side. So non-self-settled is super important because if you're the beneficiary of the trust, it's easy for the courts to say, hey, he's benefiting from that. We can pierce through that, right? You have ownership in a sense because that's who owns the assets in a trust. in the Dynasty Trust, and we'll get into that, is the beneficiaries. Irrevocable. You can't revoke the assets back into your personal name. That's super important because we don't want to own things, right? We want to remove all semblance of ownership when it comes to these structures. Non-grantor. Grantor, again, the grantor is who owns the assets. So we don't want to own assets. So it would make sense to have a trust set up as a non-grantor and be non-gifting. That's another important part, which we'll get into. But that's how you don't own the assets. Non-statutory, super, super important as well. This means that these trusts do not have to comply with state laws. There are statutory trusts, excuse me, like domestic asset protection trust. There's also statutory dynasty trust. Pretty much every trust out there, if you go to an attorney, they're going to set you a trust up that's in accordance with what we call uniform trust codes in that state. Okay, so there's a statutory trust, but you can set up a trust that is non-statutory, basically has a federal charter that's based on contract, because every trust, doesn't matter what trust it is, charitable trust, special needs trust, it is a contract, right? So when you kind of understand contract law and uniform commercial code, that's a super important thing to understand about these trusts, because a lot of people, if you go online, you might hear about, oh, common law trust, or I have this type of trust. Common law kind of went out the window years ago. We still do follow common law, but the UCC, the Uniform Commercial Code, basically replaced a lot of the common law statutes. So that's super, super important to kind of understand. Complex provisions. Again, we talked about simple means that the trust has to distribute. Complex means the trust does not have to distribute. So the trustee can say, hey, we don't, there's $1 million in this trust. The trust earned $1 million from its investments this year. We don't want to distribute. If it's a simple trust, it has to distribute, okay, because it's using a different tax code. And again, I'll go into how that works. Dispositive powers. This gives uh, the trustee the authority to say, hey, we can not only not distribute that income, but that allows you to defer that tax for generations. Again, this is the reason why these wealthy families keep getting wealthier, is because they're not getting killed with taxes. Because they know if they got killed with taxes, they wouldn't have as much money to reinvest. And the dispositive powers is a super, super important feature. And then the spendthrift organization, this is really what gives it the ironclad asset protection, because essentially the assets in these trusts are considered welfare benefits for heirs. Okay, so not only is there, hey, these assets are owned, right, by the beneficiaries, which are not going to be you, they're welfare benefits. So it really avoids, any semblance of the courts being able to pierce you. We have cases upon cases of precedents where even the IRS was not able to pierce through these trusts. Okay, that's how powerful these trusts are structured. Okay, so the way the structure works with these specific dynasty trusts is the grantor, the person who's setting up the trust, is someone other than you. It's not you. It's not your spouse. It's not your kids. It's not your parents. It's someone that has no familial relationship with you. Okay, that's a person who is the grantor of the trust. They're establishing the trust. They're funding the trust. $50, $100, set up the bank account. They appoint you as the trustee, who again has ultimate control. You appoint successor trustees, and then your beneficiaries or whoever you name, your kids, a charity. You have a lot of clients that are philanthropically motivated and charitably inclined, and they like to give back. So we show them how to use this strategy that way. But at the end of the day, the person who's setting up the trust is someone other than you. So you only hold one position, which is super important because the IRS has something called the control test. And the control test basically says that the more positions you have in this trust, if you're the grantor and the trustee, or if you're the grantor and the beneficiary, that's basically you, right? You're doing it for yourself. So we can pierce through this trust. But if we can structure and manage and set up the trust where someone's creating the trust, they're funding the trust, they appoint you as a trustee, you appoint your beneficiaries, and then this grantor resigns from the trust. So now they're disassociated from the trust. They have no access or rights or anything like that to the trust. Now you have not only ironclad asset protection, you have control. And so that's really the position that you want to be in. So to kind of compare this to an individual, because I like to make things simple. Dynasty Trust, you're just saying, hey, I was doing things in my personal name, my personal estate. I just want to do it in my Dynasty Trust estate. So it doesn't matter what you're doing, real estate, crypto, we have people that have businesses. You can do that in the Dynasty Trust. So whatever you can invest in, whatever you could buy, if you could buy a car, you could buy a house, the Dynasty Trust can do it. Okay. It's going to have its own EIN. You have a social security number. You report income on the 1040, the trust reports the income on the 1041. You have a bank account, the trust has a bank account, separate. Bookkeeping, profit and loss, you probably don't have a, most people don't do personal bookkeeping, I do, but balance sheet, credit score, that's what the trust is. It's basically has its own statutory, not statutory, constitutional rights, okay? But it's a completely separate entity from you. So that's a big thing you have to kind of understand. And when we're setting this up and we're managing it the right way, all this is tax deferred income. This is just tax deferral, right? We're not evading taxes, we're deferring the income so that it's not taxed. And how long can we defer it? For almost ever, right? That's what they're called dynasty trusts, indefinitely. So that's all this is. It's no different than a 401k or an IRA or a 1031 exchange where you're just deferring. The only difference is with a 401k or an IRA, you have required distributions at some point. With the dynasty trust, you don't. And you can benefit from it. We'll get into that because that's really the thing when you, again, understand the mindset and kind of how this works and the structure and the uses of it, it makes all the sense in the world. Active income, W-2 income, 1099, we talked about that. That cannot go into the trust for avoidance purposes. So if you earn income and you signed a contract with an employer, hey, I'm going to get paid, you have to pay taxes on that. Same thing for 1099. I will put an asterisk around that because if you have 1099 income, there are certain things that we can do to help mitigate taxes on that income with the Dynasty Trust. But passive income, that's different. Rental, investment income, capital gains, that's different. So the way the tax code looks at these trusts when it comes to the income, basically anything that's passive, which is again capital gains, dividend, you invest in stocks, blue chip stocks, whatever, rental income, you have some rental properties, you do IP leases, we'll talk about that with businesses, interest income, you do private notes or structured notes, royalties. We have a lot of people that invest in oil and gas. I invest in oil and gas. Those royalty incomes, and then K1 passive, not active. We'll get into that. All those types of income are basically not considered taxable to the trust per the IRS. Okay, so this is the IRS. It's not me making up the rules. The IRS says it's not taxable income. What is it considered? It's considered a return of what we call corpus or principal of the trust, and we'll get into that. So essentially, what happens is all of the income that's passive goes into the Dynasty Trust estate corpus or principal that gets reported on the 1041 tax return. Then everything gets declared as an extraordinary dividend. There's no distribution, and so there is no tax. And so that's a 30,000-foot view of kind of how it works. Again, you can watch the master classes. We go more in detail, but essentially, again, you're just deferring income, no different than a 401k or an IRA. So I'll give you some examples here of use cases. This is a client we actually had here, capital gain on a property. So this is in Charlotte, had the property for about 30 years. This was the basis, about 500,000, but it was listed at about 3.5 million. And so he's looking at a lot of taxes between, again, capital gains tax, North Carolina, we have state tax, depreciation recapture. Again, that's what gets a lot of people when they sell is that depreciation that they took that, oh, it's going to reduce my tax bill this year. Okay, great. But when you sell, you're going to have to pay all that back. Okay. Depreciation is a partnership with the government. Okay. You're in bed with the government. It's like you're married. Okay. So, and when you get divorced in a marriage, guess what? The spouse can take half, right? Or more if they have a good lawyer. depending on the state. So he was looking at about, $1.1 million in taxes. And we avoided that without having to do seller financing. A lot of people will do that, do an installment sale and sell it over, a few years, or they do a 1031 exchange and just kick the can down the road. He didn't have to do anything like that with the Dynasty Trust. So the way that it works is really, really simple. You got your basis. He bought it for 500,000. So what we're going to do is we're going to sell that property to the trust for his basis. We could sell it to the trust for 3.5, but then he'd be paying capital gains taxes, which we don't want to do. So sells it to the trust for $500,000, which is his basis. There's no gain. We did a bona fide sale. So the difference between these types of trust and your land trust or living trust is when we convey properties, when we convey assets over to the trust, we're selling it. We're not gifting it. All right. When you gift an asset the trust basically becomes a grantor trust. So you could have done everything right, set up your dynasty trust and this and that, but the minute you gift an asset into the trust, now it becomes a grantor trust and loses all its asset protection. So what we do is we sell assets into the trust, which is no different than me selling my laptop to you, right? Once I sell my laptop to you, then I don't own it anymore, right? So we sell that to a completely separate entity. Again, the trust, we only hold one position, right? We don't hold more than one position, so we don't own it. We're just the overseer manager of that trust, and we do it by legal contract, okay? So we sold everything over to the trust. The trust now owns it legally. There's a demand note or an IOU of $500,000. So that we have to make this a bona fide sale when we go and do the contract and purchase and sale agreement and all that stuff. The trust, there has to be some consideration. We're not just selling it for $1 and not expecting something, right? The government looks down on that. So, hey, $500,000, we're selling it. But the trust, we basically have a demand note or an IOU, a note payable on the books of the trust that we can use later on. And so now the property's in the trust can go ahead and sell that property for 3.5. And as long as all the income goes back into the trust, there's no distribution, there's no capital gains tax. And so that's kind of how the Dynasty Trust works from a capital gains standpoint, whether it's real estate, crypto, a business. We have a lot of clients that are selling their businesses, they're getting ready to retire. This is a great strategy for this because it gives you a lot more options than, again, a 1031 exchange or an installment sale. You don't have to find property within a certain period of time, close on it, deal with depreciation for capital, all these different things. It allows you to sell, avoid the tax, keep your cash, and figure out what you want to do with that. And we'll talk about what you can do with the money in the trust in a little bit. Income from an S corp. This is a client. This is not her actual picture. We did this for protection purposes. But they're in Columbia, South Carolina. We're going to look at her tax return in a bit. The net income was about $344,000. So their tax liability is about $65,000. Now, being an S corp, what does an S corp require? An S corp requires you to pay yourself a W-2 salary, right? And take a K-1 distribution. And so she had done all of her expenses, written off this, written off that, but she still had a huge amount of net income. And so you see right here, net income, the W-2 is 197,000. She had some K-1 distribution. So her total income was $343,000. This was the adjusted gross income was 389, but after deductions and all that stuff is 343. And so her tax liability, this is her tax liability. Okay. So it was pretty much early that year. The next year, there was not a whole lot that we could do. She earned the money, but they said, okay, let's start planning and putting everything together and things of that nature. So how we structured this was very simple. Okay. Because of her business, and the only clue I'll give you to her business is that she's a licensed professional, licensed medical professional. So she had to kind of keep her structure a certain way. So everyone's situation is a little bit different, but she basically kept her S corp intact. What we did do is we did do what's called a reasonable compensation analysis, because one of the things we realized is that, okay, you have to pay yourself a W-2 salary, but do you need to be paying yourself $197,000, and she didn't. And so that helped us a lot with her strategy. But essentially, all she did was she paid contract fees. And the ironic thing, and I'm not even showing the 1120S on here, what her company made, because I think her company made like two or $300,000 more than what it made the year before. But all she did was she paid contract fees to the business trust. And those contract fees that are paid to the business trust can be for anything from marketing to administrative. Basically, we're paying the business trust to do something that the S Corp already does. And we have a whole bunch of different things that we can figure out what will work for your business. But we said, hey, let's pay those contract fees to the business trust. Business trust can pay the vendors and pay those expenses through that, but we can make those contract fees based off of what we call prior period revenue. Okay. And so we can use a period, whether it's quarterly or monthly or even annually of gross revenue, and we can say, okay, that contract fee is going to be 90% of that gross revenue. So let's say we're making it off of yearly and your gross revenue was $1 million. If we can make that contract fee 90% of $1 million, that's $900,000 that we can pay to this business trust to do those fees, to do those services legally through a contract. Okay. There's lots of different variances and things of that nature. She sought to pay herself a W-2 salary and take a K-1 distribution. But now all that income goes into her business trust. And from the business trust, it goes into the family trust because the family trust is essentially the beneficiary of the business trust. So at the end of the year, we're going to have this business trust distribute income. So we talked about before simple and complex codes and how we don't like distributions because they're taxable, which is true. But if they're taxable, if we distribute to an entity that doesn't pay taxes, and we can label and recharacterize that distribution as a beneficiary distribution, then we don't have to pay taxes. So she was able to take a huge chunk of income from that business that she still had into her business, into her family trust, essentially. She still paid herself a W-2 salary and K-1. It was a lot less. And so you see right there, hey, $75,000 in W-2, huge savings. So now our taxable income went from 343,000 to 35,000. I mean, a huge difference. Again, everyone's situation is different. This helped out with college stuff too, because she had some kids looking to go to college and get financial aid, and that helped out. And I'm not even showing that, but these are types of things. So you go from a $65,000 tax bill to about a $4,000 tax bill because of how you're structured. Rental income. Again, this is not the actual client. We're not putting their face there, but he's in Fort Worth, has 23 properties. And these are all properties he got like a long time ago. They're actually bequeathed to him. And he's got a huge amount of rental income, and everything's been really fully depreciated now. So he doesn't have a whole lot of expenses that he can write off. So he's like, what in the heck do I do? Because I have all of this income and I have to pay taxes on it. So this is, the income that we're looking at that year was around 311,000, and that was his tax bill was gonna be, but we restructured everything. So how we did it was very, very simple. We took those properties, took the adjusted basis, and we sold those properties over to the trust. So no different than if we were trying to, avoid capital gains, we're going to transfer those assets to the trust for what our basis is adjusted because again, you took depreciation. So if you take depreciation, we have to calculate that in that adjusted basis because that's part of the tax code. So same thing, notarized bills of sale, contract, deed, all of that stuff done. Demand note that can be used later on again for non-trust expenses. We'll get to that. But all that happened is we said, hey, we're going to take the properties, we're going to change the rental agreements, going to put the properties in the trust, and now all the renters have to do is just pay the rental fees to the trust bank account. They just write in checks differently. That's all. Okay. And so all that rental income goes into the trust. The properties are owned by the trust, so he's got the asset protection, and he doesn't have to worry about any taxes or hey, I need to buy another property to appreciate it. He doesn't have to do that. And this guy was at a point where he just didn't want to buy any more properties. He was kind of fine where he was at, and he didn't want to buy any more real estate. 1031 exchanges, we kind of talked about this. Dynasty Trust is allows you to buy from a position of power. You don't need to do 1031 exchanges. They essentially become obsolete. I could literally have an hour and a half class about the difference between Dynasty Trust and 1031 exchanges, but suffice it to say that the biggest difference is that you're not going to have to, deal with the deadlines and the stress of those deadlines, right? The 1031 exchange is one of the biggest reasons why they fail is because of having to meet the deadlines with either identification or exchanging a property. And it limits you. With a 1031 exchange, you can only buy so many types of property. You can't go buy a primary residence that you live in. It has to be for real estate or investment purposes. With the Dynasty Trust, I can sell, avoid the tax, keep the cash, and then go buy a house and then live in the house personally. Now I have to pay rent to the house, right? We'll get into that. But there's all these different things where a Dynasty Trust is so much superior to a 1031 exchange. And the biggest thing I would say is just the timing, because you can purchase at your own timeline. 1031 exchange, if you're trying to sell and you're just looking at 1031 properties, you don't know what if the cap rates are even good, you're buying at the height of the market. Dynasty Trust, you can purchase whenever you want. Sell, say, hey, I'm going to sit and wait and figure out what to do. So it just allows you to be a lot more efficient. So the big thing to understand is the dynamic with the Dynasty Trust versus how most people do things. They work, earn money, pay taxes, and then they pay for their bills and expenses with after-tax dollars. And wealthy people understand this, which is why the Dynasty Trust makes a whole lot of sense for the situation, because now you could work, earn money, make the same amount of money, because now you're not paying taxes. So not only not paying taxes, now I get to pay for expenses on a pre-tax basis. And this is really what is the lifestyle change, the mindset change, and why wealthy people, we hear about trust fund babies. I knew some people. I went to a very elite kind of private school in Florida for college. Got there on scholarships. My parent couldn't afford that school, but I was rubbing shoulders with people that were trust fund babies, and it's actually a good thing because those people are like the most responsible people in the world because of and not only that, they're efficient, but that's a whole other story. But now we can pay for the same things that we were paying for after tax on a pre-tax basis, and we'll get into that. So what can you do with the money in the trust? Yes, we avoided taxes legally. We have the asset protection, but now I have all this money in the trust. What can I use it for? And that's kind of a big thing that people get hung up on because it makes sense, right? It's your not even it's not your money. It's not your money, right? So just big mindset shift, right? But I have all this money. I can control it. What can I do with it? So the money in the trust or trust funds, right, can be used basically for four main things: trust assets, trust investments, expenses, and then trust responsibilities. So trust assets, again, anything that you can purchase as an individual, the trust can purchase. I don't care if it's real estate, if it's a boat, if it's a car, Forex, crypto, life insurance. We have a lot of clients. We show them how to use life insurance, whether it's whole life or IUL or UL, infinite banking. If you like that stuff, you will love how the Dynasty Trust works because it makes it even better. You can buy life insurance on a pre-tax basis. Annuities, oil and gas, anything that you can purchase as an investment, the trust can do the same thing. Again, EIN, bank account, books, as long as you put everything, record everything right, the trust can do it. Um, Primary residence. So again, you live in a house, you own your house right now, you transfer your property over to the Dynasty Trust. Now we can have the trust dollars from your business, from your investments that you're not paying taxes on. Now we can have that same money pay your mortgage and your property tax and your insurance and your utilities, your maintenance, your all of these different things. We can have the trust dollars pay for those things on a pre-tax basis. And when you're in those higher income figure range, again, you're not a billionaire or gazillionaire, but you make three, four, $500,000 a year, $1 million a year, you're at the highest tax brackets, right? So you're getting killed with taxes. And All of these expenses you have to pay after tax. So if you can pay them on a pre-tax basis, it's much more efficient, right? Whatever the trust owns, the trust can pay the bills. And we'll get into trust rules in a little bit. Mortgages, big thing we talk about with mortgages, because people are like, they read stuff on Google or here or there. Transferring your property to a trust is not going to trigger a due on sale clause all the time if it's done right. But essentially, what this is, hey, I took my property, I transferred it to the trust. The mortgage company is going to see that that property is owned by the trust, and they're going to say, hey, you owe us, 500,000 or whatever's left on your mortgage. That's what we call a due on sale clause, and that is true if you take a property and it changes hands, the bank needs to get paid, right? And so that is an actual thing that happens. But when it comes to trust, for various reasons, including federal law, something called the Garner-St. Germain Act, that is not going to happen. When you transfer the property, when you convey to the property to the trust, it is sold to the trust via a notarized bill of sale. Okay? What that notarized bill of sale does is that it legally divulges your ownership, right, of that property, of that asset to the trust. Then that note is assigned to the trust. So in that agreement, we're allowing the trust funds to now be paid for, now to be used to pay for the mortgages, property taxes, insurance, all that stuff. But that, because of how the governing instrument is written, guess what? You don't have to actually file that deed. So the county doesn't have to be any the wiser that the property is in the trust because of how everything's done. Your deed is filed, it's put in the governing instrument, but it doesn't have to be actually filed with the county. Okay. It's a private contract, it's a private deal, private trust, everything. Okay. So there's just so many different things. And even if you did file it, because we have some clients that do want to file it, and obviously get things out of their name for just viewing purposes, it's still not going to trigger a due on sale clause. And we I can go in detail of why that isn't, and client experiences and all that stuff, but that's not an issue. Vehicle, same thing. Put your vehicle in the name of the trust. You sell it over. Trust now owns it. Now the trust can pay for the auto loan payments, the note, the insurance, new tires. My car's in my trust. I got to get new tires. I have run flats, and those are a pain in the butt. But guess what? The trust bank account is paying for all of those things, and is paying for it on a pre-tax basis. Trustee expenses. This is a huge, huge thing. Okay, because a lot of trustees, and this is again the role that you'll be when if you decide you want to set this up, the trust, even though you're the trustee, you don't have any ownership, there are a lot of expenses that you can use for inside the trust. So for example, healthcare expenses, you can take a stipend. If you wanted to take a stipend and pay yourself a W-2 wage from the trust, you can do that. But besides that, the trust can pay for your healthcare expenses. It can pay for your life insurance. You have to understand, something were to happen to you, you're an integral part of how those assets are going to get divvied out to the beneficiaries. So you can get life insurance on yourself, have the trust pay for it. You got to make the trust a beneficiary, but there's all these different things that you can do. Education, right? If there's certain things, we have a client now that he's going to start doing some syndication deals with real estate, and he's going out to some conference in Colorado or whatever. We just helped him out. These are things that he's using to perform his duties as a trustee. So guess what? The trust can pay for that tuition or fees or whatever. So there's lots of different things that even as a trustee, that you can use the money in the trust funds to pay for those expenses on a pre-tax basis. And beneficiaries, okay? I have kids, and this is the biggest thing for people that have kids. The Dynasty Trust, it's like a non-negotiable because kids are not cheap. Okay, if you have kids, you know exactly what I'm talking about. But beneficiaries, and again, this is one of what we call trust responsibilities. This is what we call the HEMS provision, Health, Education, Maintenance, and Support. The trust is obligated to pay for those expenses for any dependent that's under the age of 21, and or if that person has special needs or if they're disabled, there is no age limit. But the trust can pay for all of their healthcare expenses. every time they go to the doctor, out-of-pocket expenses, braces. I just got braces. Guess what? These things are paid through my trust. My daughter, she got braces too. It's paid through the trust. Food, food. How much do you spend on food on a weekly basis, right? Every time I go to Costco, it's like, what the heck? I got the receipts. It's not cheap. So food, clothing, all these different things, they can be paid for. Well, let me just turn this off. Probably my wife or one of the kids. I apologize. All right. Um, they can be paid for on a pre-tax basis. Food, okay, clothing, gotta, clothe your kids, education, college. This is one of the biggest things that we use this trust for when it comes to if you have kids that are in high school, and I will say this to you, if you have kids that are in high school, they're sophomores, they are juniors, you need to get this done like right away. If you got a lot of income, a lot of assets, you got a child that's going to college 2027, this is the year that they're looking at for financial aid. So there's things that you need to do to be more efficient. And so what the trust does is it allows you to pay for education. So not only can we legally get assets off of our personal balance sheet and reduce our income drastically, now we can use money that's in the trust to pay for those educational expenses on a pre-tax basis. So much more efficient way. Now, can't do everything with the trust. Okay, this is not a Swiss Army knife. It's not going to cover every single thing and then some. So there's certain things that the trust can't pay for, what we call food, fun, and fashion. When I say food here, what I mean is food for adults. So if you don't have kids, if it's just you and your spouse, or just you, and you want to go to the grocery store, you can't use the trust funds to pay for that. Okay, or McDonald's or stuff like that. Fun, hey, I just want to go to Disney World or the movies or this. Okay, you cannot use the money in the trust to pay for that. You want to get your wife a new Gucci purse or a diamond ring or some Jordans. The trust can't provide those things. So there's certain things that the trust cannot pay for, and you cannot use the money in the trust absolutely to pay for those things. You can take money from your demand note. So when you sell assets over to the trust, there's going to be an amount that you can take from the trust and not pay taxes. Basically, the trust owes you that money, and you can use that to pay for those out of pocket expenses. But you cannot take just go into the trust and then expense something that's not a trust expense. So it has to be a trust expense. Now, the flip side, what can the trust pay for? So food, fun, and fashion, just changing our viewpoints. Hey, you got kids, snacks and groceries for the kids. Boom, the trust can pay for that. So if you got kids, all your grocery bills will get chopped down in half, and you pay for a huge chunk of it on a pre-tax basis because you can use the money in the trust to pay for that. Fun, hey, you got kids, you want to go a trip to a museum, something educational, or hey, you have real estate, you're trying to do some site visits and look at some properties over here or there. You can use the money in the trust for that. Kids' clothing, business attire. You're the trustee. You need to show up to a business meeting or meet with attorneys or this or that. You can use the money in the trust. So there's different things. There's always nuances, but the end of the day is just understanding what you can use the money in the trust for. So trust timeline. So just to kind of give you an idea of, if this is something that you're interested in, how that would work. It's not something that happens overnight. I meet a lot of people, hey, we're closing on a property tomorrow. I'm sorry, I can't help you. There is I'd say there's a good 30 days is a good time frame. We can set the trust up in as short a time span as about 2 weeks, but anything less than that, it's just probably not going to happen. Just because there's so many different steps involved, setting up the trust and all that stuff. So just kind of understand that, especially in light of 2025, because we are at pretty much the end of Q4. It's what, November 4th, right? And so if you have a business, especially for business owners, you need to get hopping on this now, because if you have not made any distributions from your business, okay, this is your opportunity where you can look and say, hey, instead of me buying another skid steer or putting money in a 401k or IRA, which is not bad, you can do that, but you don't have to prepay expenses and all these things you can squirrel away money, have a huge impact from a tax standpoint, and just be a lot more tax efficient and have the asset protection. And this is one of the things that we talked about with the guy who bought the skid steers because, hey, yeah, you bought all the skid steers, it's in your personal name. Right? You have an asset that you own. So it just really doesn't help you. So just to give you a realistic idea of the timeline is the next step, you say, hey, I want to look at this. We do an introductory call and then kind of understand your situation, see what you're looking for. Is it going to work? Is it not going to work? Go over your situation in detail. And then we do what's called a tax estate evaluation, which is a complete breakdown of your tax situation and how things will work with the trust and other strategies. So again, we'll talk about the recovery, the reduction, restructuring, because a lot of times with the recovery, that'll help pay for the cost of a lot of this stuff. But we do an introductory call and evaluation. If you say, hey, okay, great. After that, if everything looks good, and that whole part, the introductory call, that takes about an hour. The evaluation that might take 3 or 4 days, depending on our caseload and how soon you can get documents to us. We do a complete intake form, get everything rolling, secure the payment. EIN immediately is created. Okay, so this is an active trust from the jump, irrevocable trust. Your trust books are prepared, designed, customized for you and your situation. You need two trusts, you have a business trust. Sometimes people have three trusts because they have business assets. So there's all these different things. Then your trust books are delivered and activated. So everything has to be notarized and witnessed and put together. You got to set up your trust bank account because we have to fund the trust. Again, if the trust is not funded, it's not an actual valid trust at all. And then we introduce you to our bookkeeping and CPA team to talk about the tax and ongoing stuff. And that is a thing to kind of understand of, okay, is this going to work for me or is this not? Especially in the light of what we talked about. Hey, how much income are you earning from passive sources? How much assets do you have? Because you're going to need to do bookkeeping for the trust every year. You're going to need to do a tax return every year. There's compliance things that you have to do. Now, that being said, it is uh, less compliance logistically, I should say, than an LLC or an S corp. Because an LLC and S corp, you got to do not only books and tax returns, you got to do annual reporting with your state, right? With the Secretary of State. You have to do annual filings. You have to have a registered agent, all these other things. You don't need any of that stuff with the trust. So the trust is actually a lot more efficient logistically because there's lots of other things that you don't have to deal with, but there are things that you have to do. Then you sell assets and transfer everything, sold to the trust, do the notarized bills of sale, the demand notes and all that stuff. And from that point, it's just maintaining your trust and, looking as things change. Now, one of the things I like to let people know, even though it's irrevocable, and it's like a lot of people are scared, hey, irrevocable, I can't change anything. No, you're the trustee. You can make a lot of changes while you're alive. Okay, you can change beneficiaries, you can change this, you can change that. So there are some certain things that you can change, even though it's an irrevocable trust. So hopefully that gives you a realistic timeline of kind of what to expect. So, kind of wrapping up, what do you risk by continuing to operate in your personal estate? We talked about taxes, liabilities, and lawsuits, but again, there's just so much other things that people don't realize in this country. It's all based on what you have in your personal name. So not only that aspect of it, Medicaid spend downs, filial responsibility. This is something that people don't understand. Not every state this applies to in North Carolina. This is applicable, but basically, filial responsibility means that if you have a parent, say you're a child, you have a parent that's elderly, certain states can force you to, basically pay for their elder care. A lot of people don't understand how that works. Eminent domain. We have a lot of cases. We had 2 cases last year where this trust was able to avoid eminent domain. So you're talking about really powerful things here. But again, it's just understanding that, hey, when you have things in your personal name, when you own things, people can take it away from you. And once you kind of understand that, then it makes things a lot simpler. So this is doing things differently. Okay. You are going to be, there is, I like to let people know up front, there are going to be some changes that you have to make. Yeah, there's not a whole lot of changes from a expensing standpoint and kind of what you spend your money on, but there is definitely a mindset change. Hey, I'm selling this property we had for 20 years in our personal name, we're selling it over to the trust. It's a lifestyle change. Hey, when you go to the bank, when you're doing this, you're going to do that, you have to use your trust account. And it's a family change, most importantly, because this is about creating generational wealth. This is not a flash in the pan type of deal. Okay. People that set up these trusts spend their entire lifetimes training their children and their grandchildren how to be stewards of wealth. And that's why the Rockefellers have the amount of wealth that they have today as compared to the Astors or the Vanderbilts. If you do your research, they don't, they're well, Anderson Cooper is like the last one left because they didn't have these structures and they weren't changing. People just thought, oh, it's my money here, I can go spend it. No. So it's there's a lot that goes into this. We have a whole training. There's a really good book I would highly encourage you to check out called The Art of Passing the Buck. There's 2 volumes. This is one of the things that we teach in our program because it really delves deep into kind of not only how things are set up, but how to actually start doing these things and making sure that this stuff actually lasts for generations. So that being said, a lot of you guys here are just you want to learn. You're probably just starting to get everything set up with your structures, and you're really in the learning phase. And we again meet people where they're at, and we want to support that, which is why we provide a ton of education. Again, go on our YouTube page to the Tax Estate Academy. We have a whole bunch of stuff there, but we also have the actual Tax and Estate Academy. And if you text the word T to the number that you see right here, 919-420-3798. You can join that program. It's $97 a month. You get members only learning portal, detailed strategies. We have Ask the Experts call. We haven't had that in the past a few weeks because we've just been busy with Q4 stuff, but we're gonna have a call in the next few weeks on a really cool strategy for W2 people. But this is a really good place to really start your learning and understanding these things more in detail. We have a whole bunch of different training on different strategies, supporting documentation, all this stuff. So you can really understand how to put these things together and learn it before you just jump into it. And really get it from a tax strategist and planners and people that do this all day, every day type of point of view. But a lot of you may want to really say, hey, it's Q4, I'm doing this, I'm selling a property, I have this business, I have this investment, what do I do? You want to talk about this more in detail. I would highly suggest that you schedule a one-on-one consultation to talk about your situation more in detail. Again, we're going to have some Q&A here in a little bit, but if you want to talk about, hey, how do I get going? What are the next steps? Talk about your situation more in detail, answer questions. We can go over recovery, reduction, restructuring opportunities, talk about the tax and state evaluation, how that makes sense. Then I would schedule, I'm sorry, not schedule, talk, just text talk, TALK, to the number that you see here on the screen, 919-420-3798. I'm going to put that in the chat box as well. That is a first come, first serve. We get a lot of requests. We're super busy, especially with Q4. We have a lot of client meetings this time of year. So just understand we're probably not going to have every date and time available, but book a call as soon as you have the opportunity to start learning how to implement this stuff more in detail. So that being said, that is it. I will stop my share. Appreciate you guys for hanging on so long, and I will open up the floor, unmute you guys, and we can just take it from there.
Hello, this is Kevin.
Hey, Kevin.
Hey, thank you for this presentation tonight. And first question I would have is, how are the trustees compensated or paid or receive distributions, if that's the right terminology, from the trust?
You mean like personally?
Yes.
Yeah, so they can. And again, this is a case by case basis. So we have some people dealing with a guy right now. He just sold about like, I have kids, so 6, 7, 6, 7, about $6, $7 million in real estate. He's retiring. He's like, age 70, he's like 72, or I can't remember. But what he's going to do, because he had a really low basis because of all his depreciation, so he's doing that. He's paying himself a W-2 salary. We're helping him. We're doing actual compensation reports and stuff. So he doesn't get taxed too much because he's got Social Security, he's got 401k. So you're looking at a whole bunch of other taxes. But it's on a case by case basis. So you can 100% pay yourself. There's not a particular formula. There is and there isn't. It depends on the amount of assets, but that is definitely something you can do. Obviously, no, it's an expense to the trust, right? So it's not a distribution from the trust. It's an expense to the trust, but you're going to pay taxes on it personally.
Okay. So that's normally through a W-2 and not a K-1.
Yeah, not a 1099. I mean, you can do 1099. W-2 just looks so much more cleaner from the IRS standpoint.
Okay. And the reason I asked for, I have several businesses and that I'm considering bringing those businesses under the trust. So, and as a executive manager or manager of the businesses, that's where I'm trying to make the connection in in managing the businesses that are
Gotcha.
now or to be under the trust. How is compensation gathered?
Gotcha.
That's what.
Yeah, now remember your businesses, we're going to keep those businesses separate. Well, now I'll take out my whiteboard in a little bit and go over some stuff, Q&A. But we're just going to redirect income from those businesses into the trust. So if you're paying yourself a W-2 from your business, if you have
No.
an S corp, you're not? Okay. So a lot of times we'll restructure and say, hey, why don't you just set up a partnership? Have it multi-member, and you can take guaranteed payments or GP distribution from the. Sorry about that. Oh no, scammers calling me. They call this late at night. Anyways, but they will. You can take a basically it's 1099 income, right? From your LLC. You'll pay taxes on that, but everything else can go into the business. So there's different things that you can do, but just know that we don't put the biz with the Dynasty Trust specifically. We're not putting the business in the trust because
Okay.
that's active income. We're finding ways, and I'll draw that out in whiteboard because, and that's a big thing. If you can Google ChatGPT, there's some people that got in trouble with their trust a few years ago because they did that. They put active income into the business. And again, it has to be passive, right? So
Okay.
we will set up different arrangements. Either, hey, we pay the business trust a fee. That's an easy way to do it. A lot of times we can sell intellectual property and lease it, lease back strategy, lease it
Sure.
from the trust. So there's all these different things that we can do to redirect income from the business where it's going to get taxed into the trust to where it's not, but we're not putting that business because we don't want, hey, if that business gets pierced, it's in the trust, then your trust is exposed. So we don't
Okay.
want the trust to be exposed in any way, shape, or form. We don't want people to know that there's a trust, and we can do that legally because we have the right to privacy. But it's structure, management, all those things.
Okay. Thank you.
Yeah, no problem. Good questions, and I'll draw that out because that's a common thing we get a lot with businesses and all that stuff. Um, Anyone else? See who we have here still. We got Jeffrey, Ray, Rosalind, Frank, you're on. It's late for you. Camille, Andy.
You have a question.
Yeah.
I was wondering, do you have a payment plan for the Dynasty Trust?
Yes, I mean, listen, yeah, we try to make it work for everyone. I think the best thing is let's just have a conversation, talk about your situation and all that stuff. The attorneys and everyone, they definitely like to make it fair. There's a few different financing options, all that stuff, but let's talk about structure first and the cost and all that stuff because one of the things we can do is look at your past few years tax return, and we can get you money from the government that you probably overpaid, and you can use that to pay for your trust. Okay. So just kind of know that there's lots of options. When you understand how to use the tax code, there's lots of options out there. But let's first kind of talk about your situation more in detail, structure, what you're looking to do. There's lots of strategies. And for a lot of people, I'm dealing with a few people right now. They like the trust. It's just not there yet. Maybe in the next year or the next quarter, it'll make sense. But there's a few different things that we can plug in, strategies, structures to reduce your tax liability so that, okay, now you paid less taxes, you have more money, you can use that to go buy your trust next year or whenever. That makes sense. So
Okay.
let's just kind of you know, start at square one and kind of see where you're at and what you're looking to do and see what makes sense, if it makes sense, how it makes sense, kind of start from there. But when you look at how this works in relation to your income and your assets, it's got to be a no-brainer. That's the only
Okay.
reason why it has to make sense. If it doesn't make dollars, it doesn't make sense. So it has to make sense. That make
Another question.
Yeah.
What's your view on a 508 C1A common law
Yeah,
uh, non-statutory irrevocable trust?
are you talking about a trust? Or
Private
are you
common
talking
law.
about the private, the
Private
private,
irrevocable common law
the
trust.
whatchamacallit,
The bulletproof trust.
yeah, so anything you're talking about that charitable thing, that church thing or
No,
whatever?
not
Okay.
no, not the 501, the
Okay.
508 C1A
Yeah,
common law
yeah.
irrevocable trust.
Again, when you talk about common law, and here's the thing, I've heard all those different things. Again, common law, there is no more common law. So if anyone's saying anything about a common law trust, that's out the window. Everything has to be UCC compliant. So you have the Uniform Prudent Investors Act, you have uniform trust codes, you have uniform commercial codes, you have all these different things that trust, if they're being operated right, they have to comply with those things. So if someone's throwing around common law, that's that's a red flag to me because common law really doesn't exist. I mean, we have states that are common law states, right? Like North Carolina is a common law state, but when it comes to trust and a lot of different things, it's the Uniform Commercial Code pretty much replaced all of that in the early
So
60s.
so you're saying, I mean, this trust is under the original Constitution.
Yeah, so again, all it is, it's a contract. What they're saying is it's contract, which is true. Contract law is valid. So I haven't read the trust documents. I haven't looked at the governing instrument. I'm not here to say this is a scam or that's not good or anything.
So
I just deal with this specific dynastic trust that is set up the way it's set up.
so I can schedule
So,
a call with you and present it to you and let you look at the paperwork.
yep, I'd be more than
Be
happy.
cool.
I'll have the attorneys. I'll have the attorneys look at it too. So
Okay.
forget about me. So,
All
but
right, I'll do that then.
for sure, for sure,
All right. All
sure.
right, thanks.
But thanks,
Thank
yeah.
you.
No problem, no problem. Anyone else before I get out the whiteboard? Answer Kevin's question.
I have a question about the location of the Dynasty Trust. Is there a standard location? Wyoming, South Dakota?
Good question. Yeah. So you're referring to Citus. And
Mhm.
so how that works is this is a really cool thing about the governing, again, it goes back to the governing instrument. So the governing instrument with these trusts, again, it's federally chartered. And that goes to a little bit what Ray was talking about is every trust, it's either statutory or it's non-statutory. So these are non-statutory trusts. It's basically contract law. However, you can, so it's kind of like a nebulous thing. It's operating off of US Constitution, contract, which is the Constitution is a contract. Trusts are contract. 401ks are contracts. Life insurances. So all of this, and again, if you watch the full-on training, we go more in detail. So all of this has to do with contract law. But the contract, how our governing instrument is written, allows you to choose the situs. So you can change, so you can say, hey, so like right, for example, my trust right now is I don't have a situs. Um, but if I wanted to, I could say I want to make it Nevada. I could make it Wyoming. I could make it South Dakota. And there's reasons to do that. It really depends on generation skipping tax, transfer tax. That's one of the considerations for choosing the situs. But the cool thing is the way our documents are written is you can always change the situs. So whatever your property, whatever, and this is important with real estate, especially because people don't understand this with real estate. Real estate is always based off of your state, where the state is. That's how real estate law works. So if I have property in Ohio or Texas or North Carolina, I get sued. It's going to the North Carolina courts or whatever state court, regardless of where my trust is, right? So, but the protections that you get from an asset protection standpoint and a tax standpoint, that still stands. So to answer your question, there isn't really a situs. You can choose to domicile or situs your trust in any state and always change that. And again, that's one of the things that even though it's irrevocable, you can always change and amend that. So good question. Hopefully I answer your question. Um, anyone else? Anyone else? Anyone else? Okay. Going once, going twice. All right, so let me go and go on my whiteboard and I will just answer just illustrate rather Kevin's question. Let me just change my just change screens to my iPad because I know I can write on my iPad on my iMac, but I just don't know how to do it. All right, here is the Zoom. All right, switch. All right, so I'm switching right now. All right, can everyone hear me?
Yes.
Okay, all right, awesome. All right, so I just want to do an illustration real quick just to make sure, because I have a lot of people that kind of want to understand this from a business standpoint. Hey, I have active businesses, LLCs, corporations, whatever it is, and kind of how that works. So the big thing to understand here is, oops, sharing the wrong thing. Nope. Screen. Okay, broadcast. Here we go. All right. So the big thing to understand here is, again, your LLCs, your corporations, your statutory entities, and a lot of times people have businesses where you have to. It's very, there's certain places, and I'll walk you guys through both scenarios, but especially if you're like a licensed professional, you're in insurance, you're an insurance agent. We deal with a lot of insurance agents, or you're a real estate agent, or you're a medical professional. You have some type of credentials from the state, board certified, whatever. You had to, you know, get those credentials, take a test. You got to get continuing education to keep your license. For the most part, you have to be a statutory entity, right? Because there's liability on the state standpoint if something happens or you get sued or there's some malpractice. So unfortunately, you have to do it this way through either an LLC or an S corp or whatever, right? That's the only time they'll let you. That's the only way they'll let you operate an entity. Doctors are famous for this because and lawyers, they have PLLCs or PAs, right? Which are basically statutory entities. So you have to operate it through an LLC or PA or PLLC or whatever. So you have to operate that business. But remember, your dynasty trust, I'm just going to put your family trust right here, right? This is where all of the assets are going to go. So your money, your real estate, your investments, your vehicles. This is where all the assets are going to go at the end of the day. And again, because we want the asset protection, we want the privacy, we want the tax benefits, mainly we can't have that active income in here. We can't say, hey, let's put this S corp and have those shares be assigned to that trust. We could, and if it's and what we always, for a lot of people, if you have active businesses, you're going to need probably a dynasty trust and a living trust, because your S corp, and this is what people don't understand, your S corp shares, your LLC membership certificates, if you don't have a trust and you're earning a lot of money and there's a lot of properties and assets in those entities, they're going to go through probate. And your family's going to have to go through courts, lawyers, judges, money, stress, and time if you don't have the right thing. So not all trusts are bad. You know, a lot of people accuse me of poo-pooing living trusts. And so, no, I'm not. We help people set up living trusts all the time. But from a tax standpoint and asset protection standpoint, you just have to know what it is. And it's not going to give you either of them. No tax benefits and no asset protection. Probate avoidance all day. If you have a 401k, IRA, Roth, definitely have your living trust as the beneficiary of those things for a whole bunch of reasons, which I'm not going to get into. But the reality is, what we want to do at the end of the day is we want to redirect income. We want to squirrel away net income, right? Because you pay taxes on net income, right? So all we're doing with these strategies is we're redirecting income into the trust through some type of arrangement to reduce the net income from the entity. So at all times, we're going to look at your situation. We're going to look at your income and your operations, what you're doing. And we're going to figure out ways to get that income into the trust. Okay. And there are various ways to do that. But again, the big thing is to understand that we don't want, and this is what a lot of people do, and you'll see this online. Oh yeah, I have the living trust here. And then we have the Wyoming LLC here. And then we have, some Delaware thing here. And then this goes into the trust and that and all this. It's just, and you're spending a lot of money with registered agents and attorneys and accountants every year. It's just not necessary. So at the end of the day, we don't want anything that's an active business in the trust, because those active businesses can get pierced. And once they get pierced, they're going to know, okay, that S corp, who owns those shares? The trust is. Okay, we're going to, and now you're open to a whole bunch of things, and now you lose the tax benefits. So we can redirect income. And one of the ways is, again, we went over business trust. So let's just draw that out real quick, make this a little smaller. So business trust, so biz trust. Okay, and again, the easiest way to understand this is that this is a pass through. Okay, we're passing it through just like an LLC. So income will come into here, but there are no assets. There'll be no assets in here, no vehicles, no investments, no real estate. All of that is going to be into the family trust. Your family trust is going to have your assets. Okay, real estate, crypto, whatever it is, right? And so from your S corp or your LLC, however you're earning active income, right? All we're going to do is figure out ways. Again, we can pay a fee, right? Management fee, call this professional services agreement, management services organization, right? We're paying a fee for this business trust to do something for us, administration, marketing, whatever, right? That's all that's happening. We could also, again, sell intellectual property. Every single business, I don't care what you do, you have a website, you have a logo, you have a client list, you have something that makes you earn your money. If you didn't have those things, you wouldn't, you have a credibility. You've been around for a while. They know your name, right? Those are intangibles, right? That's intellectual property unique to your business that has a value. When you sell your business, guess what? That's going to be part of the sale, right? So all of that has a value, and that value, that asset, can't touch it. It's intangible, can be sold over to the trust. Let's sell it over to the trust. Now the trust owns it, right? The trust owns that intellectual property. But now my business wants to use it. I want to use the client list. Guess what I'm going to do? I'm going to pay a lease fee. And pay a lease fee to the trust to use that, right? And what is that going to do? That's going to reduce the net income in the business, which I'm paying taxes on. So that's going to drop that down. So we can do that arrangement. Another arrangement, this is probably one of the ones we use the most, is what we call a multi-membership arrangement, where we take your LLC, and this is great for people that are considering doing S corps, because a multi-member LLC is a much more efficient way. It basically accomplishes the same thing as an S corp, because the biggest reason CPAs will tell you to do an S corp is to save on self-employment tax. But now you're paying yourself a whole bunch of income in W-2, and those K-1 distributions are active, not passive. You can't put them in the trust, and you're gonna, you have no asset protection at the end of the day. So we change that LLC to be a multi-member. We make you a general partner or a limited partner of that LLC. And what we do is we make the trust a limited partner. Okay. Remember, limited partners have limited liability. That's good, right? We don't want to own anything. So they don't own, no ownership. No ownership. They don't own anything in that LLC. No voting rights, no certificates, no stock, no nothing. They're just an investor. So my trust, my family trust, can say, hey, I'm going to invest $1,000, right? We're going to invest 1,000 G's into your LLC. And in return, because of the agreement and the operating agreement, everything you put together, I get a 90% return on my investment, the net income. Now, the general partner, you're only paying taxes on 10% of that income. We do this all the time. I'm working with a business owner right now that makes about $2.5 million. And he's getting killed in North Carolina. And you talk about Obamacare tax and all these, it's crazy. So there's all these different things that you can do, but it just requires being proactive, and it requires understanding how to use a tax code to your advantage. So you have an active business, lots of different ways. Even though it's active, you can't, and this applies for 1099. So you're a 1099 salesperson, that's active. You can't put that 1099 in the trust, right? Now, the one thing I will say is, if you're not licensed, okay, generally speaking, if you're not licensed, you don't have something where you have to, have certain credentials to earn that income. I have a client right now. She has a traveling agency. She's been doing that through like Disney and Universal and all these different things. So this is what we're doing with her. And this is something you can do, is you can operate, again, going back to Hershey's, right? And Standard Oil, you can operate through a business trust. So we have some clients that operate through a business trust entirely. They do everything. They don't have an LLC. They don't have an S corp. They pay vendors, right? They do marketing. They do everything from this business trust. Okay. And if they need money, okay, they can 1099 themselves, pay yourselves a 1099 or W-2. Here's the difference. The 1099 and W-2 is not required. So if you're like a lot of my clients that have a lot of kids, or younger kids, I should say, that they say, hey, listen, and this is something that we do when we do the tax and estate evaluation. A huge percent of my expenses are trust expenses. I don't need a whole lot of income. So I don't need to pay myself a whole lot of personal income, because dang near half everything that I pay is could be covered from the trust. So guess what? They're just going to redirect a huge chunk of that income right into their family trust, and save a whole bunch of money in taxes. Okay. So there's lots of different ways to do things. It just really boils down to, your situation, where you're at right now, what you're looking to do. Hey, you're looking to sell your business, you're looking to take new partners on. There's all these different things that you have to consider to figure out what's going to work the best for your particular situation. So hopefully that makes sense for you. Oh my gosh, it's 9 o'clock. Time. Oh my God, it's like super late past. So appreciate you guys hanging on. Any other questions?
One follow-up from Kevin.
Yeah.
So you just mentioned that the business trust doesn't have any assets. For example, let's say the business owns a building and the business owns a vehicle. How do you transfer, or do you transfer the current business assets tangible assets into the family trust or sell it? How does that work when it does have asset?
Good, good. You're making me eat my words, Kevin. So good. So let me go back to this because that's super important. And this is one of the reasons, and one of the, again, figuring out what's going to work for your situation. So we have a lot of clients where they do have business assets. They have vehicles, they have equipment. Again, we work with a lot of people here in North Carolina. In rural areas, they have trucks, construction workers, all that stuff. So when you have business assets, okay, let's just talk about this for a second because this is super important, even though I know it's kind of late. But business assets, for the most part, right now they're in your LLC, right, or your corporation,
Yeah.
right. And again, you have exposure, right, liabilities, lawsuits, they can get pierced through. So we want to have that asset protection, but we still want to segregate our business assets from our personal assets, right? And one of the things that we encounter a lot, and I'm not saying that this is your situation or whatever, but hey, I'm married, we've been together for a long time, I built this business from the mud, things can happen, right? So there's all these different things where a lot of people they want to separate their business assets from their personal assets. And so for that reason, it may make sense to set up another, still a beneficial trust, but it's a business, we call it a business asset trust. Okay. So it's the same thing, you have business bank accounts, real estate, equipment, vehicles, but we're going to put it in a separate trust from our family trust. And that's good for so many reasons. But the biggest reason is, let's say this business, and this is, and hopefully, I think you might be going in that right direction, but we have those assets that are in the trust. We took those assets, we sold them over. Now they're owned by that business trust, but we still need to use them. What do? We lease them. We lease them from the business trust, which leasing expense, rental expense, that's passive. The business trust doesn't pay taxes on that income, right? And now there's less money in my business, right? So it's the same way. You can there's multiple ways. We have some people, I have a guy that does a lot of franchises, and he'll do different partnerships. So he sets up multiple trusts because he doesn't want he wants to kind of keep things segregated. You don't have to do it like that. It's not a requirement. We have the guy that I showed you in Texas with a whole bunch of properties. All those properties are in one trust. So you don't need to have 20 different trusts for each different property you have. You don't have to do that. It's just the activities and what you're looking to do and all that stuff. So really good question. But again, that's one of the reasons why we have to figure out what's going to work in your situation. Because some people, hey, they want to separate their business assets from their family assets. Some people don't. It just depends on your situation, the scale of your business, and a whole bunch of other things. So really, really good.
All right. Thank you.
So, all right, folks, that was it. Thanks for staying on with me for 2 hours. I'm going to put in the chat again, just the two things. Again, if you want to schedule if you want to join the Tax and Estate Academy, it's TEA. I'm going to drop that in there. If you want to book a call, and you'll get access to our calendar and see the best time to meet up. You'll text talk and the number here, and I'll just leave it on the screen. Keep my screen open for a little bit. 919-420-3798. So you can text those two things to, depending on what you want to do, to that number, and you'll get access to that. And hopefully I answered your questions, and this was an eventful meeting for you, and you learned a lot, and you got to kind of see this a little bit more on an in-depth level and understand, hey, is it for you? Is it not for you? Again, that's my main goal when we have these training sessions, is for people to really understand the truth, the whole truth, and nothing but the truth. Hey, is this something that can work for me or not? And then take it from there. So hopefully you guys got that. And other than that, you can go to our master classes. It goes a little bit more in detail. If you have questions, you can show up on the next Tuesday call and kind of take it from there. So that's it, you guys, and have a great night. And sorry for going over. Bye.